But yes, the Dow yesterday fell to about 600 points and then ended up rising 250 points. So that was a big rally that we saw in the Wall Street indices. Nigel is here for the World View.
Well, all's well that ends well, and that's precisely what happened. The US markets, they ended with good gains in yesterday's trading session. We had quite a few winners in terms of the Dow. IBM was one of the big gainers. P&G as well was up and about in yesterday's trading session, and even 3M. All those stocks, they were the biggest gainers in trade. But if you look at it, the Nasdaq was a relative underperformer because a couple of those stocks, they did come in for profit booking. The likes of Tesla, Apple, as well as Amazon, all of them were under some pressure. But the big story really was the big intraday recovery. As you said, the Dow recovered close to around 800 points from the low point of the day. And in terms of a two-day rally in percentage terms, that's the best we have seen in the last 3.5 years, or the last time we saw such big rallies in two sessions was in August 2015 odd. The problem was renewed tension between the United States and China. That was weighing on sentiment because President Trump, as per what reports indicate, he's likely to pass an executive order banning the US companies from using equipment coming in from Chinese players, that's Huawei as well as ZTE. So on the back of that, there was some fears in terms of trade tensions. But the European markets, they were under pressure yesterday. They ended with sharp cuts in the trading session. It wasn't just the frontliners. The peripheral indices as well were under some pressure. In terms of the Italian index, the Italian banking index did see big selling yesterday. Early this morning, though, the Asian markets, well, they're in a mixed bag. The Nikkei is a relative underperformer because the yen has shown some strength, so not great news for there. But we're tracking some other cues. One is that, in fact, Brent crude prices overnight, it did decline. Now it's seeing a bit of a spike up. The dollar index has weakened, so keep an eye out on that mark. And gold has moved to a 6-month high. For starters, though, the SGX Nifty is saying maybe, in fact, we'll see a 50 to 60 point bump up to kickstart trade. Back to you all.
Oh, yes, it looks like it's going to be a good start to trade for sure. Nigel, thanks so much for giving us the world view. With just 3 days away from the new year and the first month of the year, January could tell the tale whether US is entering a bear market territory or not. CNBC's Bob Pisani explains.
There's an old saying on Wall Street, as goes January, so goes the year. That's the January barometer, one of Wall Street's favorite seasonal gauges. According to the Stock Traders Almanac, it's registered only 9 major errors since 1950 and has been accurate roughly 75% of the time. But in a year when a lot of old saws are not working, this may or may not be the case in 2018. January saw a gain of almost 6%, but the S&P 500 is down in December so far. Regardless, interest for this coming January remains very high because every down January on the S&P since 1950, without an exception, has either preceded a new or extended bear market, or a flat market for the year, or at the very least a 10% correction. Now, the recent history of this January barometer has been a little bit mixed. 2008 was the worst January on record and preceded the worst bear market since the Great Depression. Very accurate. The S&P was down 38% that year. But down Januaries in 2009, 2010, and 2014 did not produce negative years, though they did foretell corrections. So that part was right. With a strong track record and so much market confusion around all these economic risks like China slowing and tariffs and the rate hike risk from the Federal Reserve and then the political risk in Washington, it's little wonder that traders are eager to get out of December and into January. But even if January proves to be a down month, there's always a bright side. According to the Stock Traders Almanac, down Januaries were followed by substantial declines averaging roughly 13%, providing excellent buying opportunities in later years. Well, that's a good way to look at it. I'm Bob Pisani, CNBC Business News, New York.
And that's an optimistic way to look at it, rather. Well, take a quick break on that note. On the other side, our list of top 10 stocks is lined up with our entire research team. Don't go anywhere.